Okay, everyone, we are going to talk about insurance starting from today. So essentially moving to Dalton book, right? T-O-D-A-T-O-N. Okay, so this is mainly from here mainly CFP curriculum because this class is designed to fulfill requirements of the Certified Financial Planner designation. Will those be covered on others? Mainly SFA. I think level 3 a little bit, okay, but most of them are related to CFP. So starting from here, I will probably just lay out the learning objective from CFP. As you can see here, I have the Dalton's money education quick sheet. This is really good to lay out the things that you need to know for the exam, solely for the purpose of the exam, okay? When I talk, I will let you know everything you need to know about the exam. However, I will add things that can give you some background, right? So introduction, we will cover life insurance, okay, health insurance, right, disability, property and casualty. So we're gonna start with this one after today's class. Then we will talk about long-term care and personal liability. So just to let you know, and also we will cover social. I don't know why it's not mentioned here. Social security, which is a public insurance system. Okay. So type of risks. This is very important. Okay. So this is from the CFP curriculum. So you need to know that we have different types of risk. Okay. One type is called a pure risk, which means there's no chance of loss, or there is a chance of loss or no loss. So you either lose money or you are who you are, right? You lose nothing. You cannot make money. Is that making sense? So you either lose money or you don't lose money. For example, if you drive a car, right? You either have an accident or have no accident, but you are not going to make money from any related accident, right? So if you are engaging in an accident, okay, you either lose money or you do not lose money. There's no way you make money from an accident. Is that making sense? So insurance company want to make sure that they just fix your car. They don't give you a brand new car. Let's say if you drive a 20-year-old Toyota, right, and then you have an accident. There's no way insurance company will give you a new Toyota, okay? So that way you make money on it, right? They only insure pure risk, which is they help you fix your car. Is that making sense? You don't make money on it. Then we have speculative risk, which is there is a chance for profit, loss, or no loss. This comes from investments. Okay? So all risks in investments are speculative. You need to understand it's very different for insurance companies and insurance purpose. Non-insurable, right? You can say we have risk management strategies. I can use options to hedge some risk. It is probably more like a bet, okay, other than insurance. You have whoever are on your counterpart, whoever is your counterparty is going to make a bet. So if you this is not investments class. I'm gonna stop here, okay? So there's no pure insurance investment, even though we have something that's designed to get rid of some risk, but that's not insurance. And then in investment, we talk about systematic and non-systematic risk, right? So you need to know that you can categorize this way. Those are covered in the CFP curriculum following the money education quick sheet. Not really covered that much in the book. So let's talk about something basic, probability, right? We talk about probability for a while when we talk about insurance companies, and then we talk about the probability of death, right? So that's a really fundamental element for insurance. So what is that? The chance of loss, right? You measure the long run frequency which event occurs, okay? The probability of how many car accident claim will be filed out of the pool of insured drivers. That's an example. The useful measure for the insurer quantifies the expected cost of claims, right? Looking at probability of loss under a homeowner insurance policy, and then apply a premium to that probability of loss. So basically, probability of loss times dollar amount of loss is should equal to the premium. We did a basic calculation a while ago for life insurance. It's not that basic. You kind of need to understand conditional probability, which is hard, right? So don't worry. Starting from today, everything will be more rules and then introductions, other than a lot of math calculations. So the law of large numbers. What is the law of large numbers? So when you have a lot of observations, right? Like you have just simply draw. If the number gets large, okay. So for insurance companies, if they have enough people, they can insure. Then the average of a probability, okay, approaches a normal distribution. That making sense? So the probability of happening, right? If you have a million, right? If you have 1,000, let's just do 10,000, right? And then you have 10,000 people, right? And then you know the probability is like 2%, right? So if you draw it, okay, if you draw it multiple times, then the probability, then the event occurring will approach 200 if you draw it many times. Okay, so you have a 10,000 sample, and then you have one drawing, right? One occurrence, and then it will be like 100, and then you do another, will be 200. If you average all those together, the average of that approaches normal distribution. Okay. The larger your sample size, the better you can predict what can be the average loss you have, because the probability of happening will converge to like 2% if you have large enough sample. Okay. Do you need to? I will try to demonstrate this later using Python if I can find it. So let's just look at it. The more frequent an event occurs, the more likely the true probability will reveal itself. I like the way it says it's easy to understand but not necessarily mathematically true. The more exposure, the more likely probability result will equal true results. There are more reliable statistics when the total pool of insured is large. So that's the whole idea, okay? That's why insurance companies want to insure everyone. Because whenever the pool is large, okay, the true probability will reveal itself. Or your loss will really be close to the predicted loss using probability. Okay, helps reduce objective risk. Talk about loss, right? What can occur loss when it's called perils, and then when it's called hazard. The perils are the actual cause of loss, such as fire, wind, tornado, earthquake, and something else, right? Hazard is a condition that increases the likelihood of a loss, occurring like moral and a physical hazard. So what is moral hazard? Is based on character flaw, filing a false claim. Okay, that's called a moral hazard. If you do a false claim, that's moral hazard. Moral hazard is you are going to act indifferently because you are insured, leaving the car unlocked if you know you are insured. Okay, so basically, if you know that some insurance company will pay you if someone steals things from your car, and then you are going to just leave the car unlocked because you have that insurance, or because you have some good insurance, you are going to drive less carefully as you would if you don't have insurance, right? Is that making sense? The insurance company need to model those into their calculations. Physical hazard is a tangible condition that increases the probability of peril occurring, like icy road, poor lighting, defective equipment. Okay, so those are also considered hazard. This is a really important slide. I promise you, you will see those on my exams. So we have multiple ways to manage risk. Okay, so if you have something very catastrophic, like financial loss, If you die, right? If the probability of death. If you die, like for me, if I die, it will be really bad for my family, right? Do I have high probability of death in my 30s? No, the probability is close to zero, right? Because especially professors, we study, we don't do crazy things, we work hard, we have good health habit, we eat a diet. Our probability of death is very low. However, there is a probability of death. And then if it happens, it's really bad for my family. It's not that bad for me because I'm dead anyway, right? So how can we hedge? How can my family hedge this kind of risk? We need to transfer it. How do we transfer it? By insurance. Insurance is a type of transfer strategy, okay? However, is that making sense? Because you have no other better way, right? And then if you have something with low probability of happening and then low severity, you will be okay. I wouldn't say a car get dented in parking lot. We don't have insurance for it. I would just say our parking ticket. A parking ticket, right? I don't know why they have this straight line. If you park a car right here in Carroll Hall parking lot, which is designed to for professors, right? You can have a probability of getting tickets, but if the probability high, maybe not that high. Okay. If you choose the right time, okay. If you choose the right time, maybe it's not that high. However, is that really bad? Maybe $20. So if you decide to take some risk, it's called a return risk. You say, I'm okay. If it happens, I will just pay it. I choose something, right? If I lose, that's fine. Is that making sense? Okay. Let me just erase those. Especially I don't like the straight lines. And then let's talk about high frequency, high severity. What is high frequency, high severity? I can think of drunk drive. So or DWI, right? Drive with intoxication. If you got drunk, or if you do something make yourself unconscious, hard to operate machines, and then you drive, very likely you are going to have an accident. Avoid it, okay? No other solution. Don't do it. Are we good? Let's just make sure we don't do it because you can be in jail. Then high frequency, low severity. What is high frequency, low severity? I think this probably like if you do a parking ticket during like daytime, right? Like right now it's 10 o'clock. If you 11 o'clock, if you choose to park here, very likely those parking people are walking, and then very likely you are going to get a ticket. Can you do? Just don't park here, right? We can park somewhere nearby. Another thing would be snow driving, right? Whenever driving when it's snow, sorry, it's not snow driving. So when it is snowing heavily outside and then you decide to drive your car, you probably have a very high frequency of accident. If you choose to drive very slowly, maybe you will have low severity. You probably just get a dent or something. How can you do it? Change to snow tire, right? This is something that can be reduced. Or I think a better example would be I just thought of a better example because I taught something very similar in Finance 111 before. Your job, you crack your smartphone, right? How many of you have a cracked smartphone? The glass is cracked. So very likely you drop it, right? Because you carry it every day and then everywhere, and very likely you can drop it. And then whenever it drops, the glass will crack. How can you do it? You can just buy a case, right? Screen protect case. They have some really nice design case for that. And let's talk about insurable risk. Insurance companies are not charitable foundations or charitable organizations. They are there for profit. So they will only deal with certain number of risks. Well, you have a large number of homogeneous exposure units. So a lot of people subject to that risk. Okay, like if you drive a car, a lot of people drive a car, right? And then for Florida residents, they have something unique. So that you need to probably separate them. Loss must be accidental. Okay, cannot insure moral hazard. Basically, like life insurance, most people will not intentionally try to kill themselves, and then they have some provision for that. If you commit suicide, probably don't get the money back. Loss must be measurable and determinable. That's why when you have a car accident, some people will come and then measure the loss, right? It's easy to determine the value of a house or a difficult amount of cash in a wallet. Therefore, coverage is limited if you have cash. So basically, in homeowner insurance, we'll talk about if you have cash in your house, then they are not going to insure up to some amount. Because why? Because people can just say, there's a fire and then I have $1 million cash. There's no way, right? It's all ash. And then there's no way they prove you wrong or right. Loss cannot pose a catastrophic risk for the insurer. They don't insure wars. Okay? Nuclear war excluded, earthquake excluded. Because if it happens, insurance company will declare bankruptcy. They don't want that to happen to the shareholders. Premiums must be reasonable and affordable. It has to be affordable, right? Otherwise, nobody will buy it. And then for underwriters, what is underwriting? So when you buy insurance, and then they have to have someone to come to you or call you over the phone to collect information from you, right? And then they will classify you into risk pools. Are you a high risk person, low risk person? And then they will give you a premium estimate. If you do have life insurance, right? They will draw your blood. Okay, don't purchase any life insurance if they don't draw your blood. That way you pay more than if they don't draw blood from you, they just assume that you have bad health conditions. Is that making sense? If they draw some blood and test it, and especially when we are young, that's good. Adverse selection is just basically those people who know they will file a claim are more likely to apply or to pay for insurance. So people who drive really risky, they have incentive to buy car insurance, right? People in bad health conditions and they know they might die soon are more likely to buy life insurance. That's called adverse selection. That's bad for underwriting, okay? So that's why underwriting or insurance company need to charge them higher premium. Reinsurance, this is more on the institutional level. So when the company has insurance, right, if they feel like they want to be more conservative because like they don't feel comfortable with some type of coverage or exposure, they can always sell that part to another institution. It's called a reinsurance. Okay. The primary reason insurance company may transfer is to reduce the exposure. Okay. Because if, let's say, they rewrite homeowner insurance and then they just worry that maybe this pool is too risky, okay? Even though they have it, but the risk level is above their comfortable level, or they probably need some cash for other reasons, they can just sell those part of insurance to others. From a policyholder standpoint, which is you, right? You don't feel anything different. However, your insurance got sold to a company overseas, like to India. It doesn't matter, okay, to you, but it matters a lot to the insurance company's financial health. So when you read an insurance contract, those are some things you need to understand. There are no better ways. You have to read it, okay. The good thing is, after taking my class, you will feel very comfortable reading them. Okay. So insurance is a contract, therefore you can have anything in place, okay. Anything legal. We have law, right? We have law above that. There's no substitute for reading the contract. You have to read it, okay? Otherwise, they will take advantage of you, and then it does touch several areas of laws. I'm not an attorney. I'm not going into detail of those. Let me just talk about some unique characteristics. principle of indemnity, I mentioned it a while ago. You cannot make profit. If you get a car accident, they will just fix your car. They will make your financial condition whole back to where you were. Insurable interest, you have to have insurable interest. What does that really mean? Your wife can buy a life insurance on you because if you die, she will suffer, right? She will lose financially. That's why it's okay for her to buy life insurance on you. However, your neighbor or someone you don't even know might not have insurable interest to buy life insurance on you, right? So like someone really random in China buy a life insurance on you, what does that really mean? They have no insurable interest, okay? So they don't have insurable interest, and their insurance company need to check insurable interest. You can buy one on yourself, okay, and then make your kids beneficiary. It's personal, cannot be transferred, you cannot sell insurance. Technically, you cannot sell insurance, but those days they have those products available at Wall Street. We will talk more about it later. It's a take it or leave it contract. A lot of contracts are very standardized. You cannot negotiate. Okay. Parties may not. Okay, so they can differentiate to the different risk categories you have. They can charge you higher premiums or lower premiums. It's a unilateral contract between you and the insurer. Okay. So from your part, you need to pay premium. From their part, when the claim happens, they need to pay the payout. A lot of insurance companies are at the state level in the United States. Okay. Then we have ratings. Insurance company, they receive AM best rating. Then Moody's also private ratings. Okay, those are ratings for companies. Okay. Not a rating for your policy. We don't have ratings for your policy yet. That's why most people get confused about what kind of coverage they have. That's why we have this class here. Okay, that's all I have for today. Let me know if you have any questions.